Okay, here is video number 2. The last assignment question. It is quite lengthy, so bear with me on this one. We have Computer Imaging Limited, who established a formal pension plan 10 years ago to provide retirement benefits for all employees. The plan is non-contributory and is funded through a trustee that invests all funds and pays all benefits as they become due. Vesting occurs when the employee reaches age 45 and has been employed by CIL for 10 years. At the inception of the plan, past service cost amounted to $300,000. The past service cost is being funded over 10 years by level annual end-of-year payments calculated at 5%, which is a reasonable approximation of long-term borrowing rates. So we do have actual funding amounts in the actuarial report that we will look at in a minute. Each year at year end, the company also funds an amount equal to current service cost, less any new actuarial gains, or plus any new actuarial losses on the pension obligation. Yield rate is 6%. At the beginning of 20X8, the defined benefit obligation was $1,400,200,000, and we will need that number later. The fair value of investments was $1,075,790, and the net defined benefit liability on the statement of financial position $324,410. The independent actuary's biennial revaluation report is provided here. So we have our current service costs computed by the projected unit credit method, which we know is in alignment with our external reporting requirements. We have actuarial revaluation, experience gains for mortality, employee turnover, and a decrease in the defined benefit obligation due to an increase in bond yield rate. So our net actuarial gains were $70,000. In terms of funding, we have our current service cost, our past service cost, our revaluation gains being deducted for a total cash contribution. We have our pension plan asset portfolio, our market value, contributions that are made based on above, our portfolio performance for the year to get to our market value, and our other information. We have our statement of financial position, accumulated OCI, retained earnings, and our earnings for 20X8. So given all of this information, we need to analyze the three elements of pension accounting for 20X8, being our service cost, our net interest, and remeasurements. We want to prepare the entries and also an entry for the contributions to fund for 20X8. And then we're going to calculate our 20X earnings after pension expenses recorded, ignoring any income tax implications, and also calculate our comprehensive income. The closing balance of retained earnings, our accumulated OCI, and our SFP net defined benefit liability as of December 31st, and prove that that liability account represents the net defined benefit position of the pension fund. Okay. So I'm actually going to do our requirements right here so that we have easier access to the numbers and hopefully a little bit less scrolling. But we start with requirement 1, which is going to be those journal entries for the three components. Okay, so our service cost, our net interest, and our revaluation, and then one for our contributions as well. So let's start with our service costs. We know that service costs increase our pension expense. So that is our debit, and this is very similar to the last question that we did. And it's going to increase the liability balance of our net defined benefit liability. Okay. So in terms of service cost, this amount is actually given to us. Okay. Our current service cost, as computed by the projected unit credit method, $85,375. So it's just a matter of carrying that number over. And we don't have any calculations as of yet. The next that we look at is our net interest, and here we are going to have to do some calculations, but we'll start off with our accounts that are going to be used. Again, with net interest, it's going to increase that pension expense, and it is going to increase that net defined benefit liability. Okay. So to calculate our net interest, what I want to do here is to take, remember I said we're going to need that number later, that defined benefit obligation of $1,400,200. Okay, I'm going to subtract from that the fair value of my investments, which is $1,075,790. Okay, and this is going to give me an amount of $324,410, which I'm going to multiply by our yield rate, okay, which in this case is 0.06. So don't confuse the yield rate, okay, of 6% with this 5% that relates to the past service cost. Okay, so just make sure you're taking the right percentage. It is the yield rate on corporate bonds with an appropriate currency and term. So it's that comparable yield rate. So my pension expense is going to increase by $19,465, which again is taking my obligation minus the fair value and multiplying by my yield rate. Okay. The third component is revaluation. And again, this has two components, right? We look at our experience gain or loss, and then we look at the revaluation on the actuarial report. Okay. So in this case, we have a gain, and I think it tells us that, yes, our net actuary, or sorry, we have an experience gain, and I think it tells us right in there that it's a gain and not a loss, but regardless, when we have a gain, we're going to reduce that net defined benefit liability. If it was a loss, of course, we would be reversed here, okay? So this again is going to be a calculation that we have to make, okay? So we're looking here at our portfolio performance, so what we actually earned, okay, which was 151,685. And then we're going to compare that to the actual, which is going to be the fair value of our asset. And we just use this number times the appropriate yield rate. Okay, so that is going to give us 1075790 times 0.06 gives us an amount of 64,547. So the difference between our actual performance and what we expected is 87,138. And again, that is a gain because we performed better than what is expected based on the fair value and the current yield rate. Okay. Second component of this is that actuarial gain that we experience due to revaluations, and this number is just given to us. So again, it's going to reduce that net benefit liability and have an impact on our OCI for the revaluation gain. And this is that amount of 70,000 that was given to us in the report based on gains for revaluation, immortality, turnover, and the decreased benefit obligation due to an increase in bond yield rate. Okay, so that covers the three components, and we next look at our contribution that's going to be made. Contributions, of course, reduce that net defined benefit liability and have an impact on our cash account because it is actually a cash outflow. So we are funding based on our current service cost, that addition of the past service cost that they talked about in the question, less any gains. If we had a loss on revaluation, that would be an increase, but in this case, it's being deducted, and that leaves us an amount with 54,228. Okay, so that takes care of our journal entries that relate to pension. We have our service costs, our net interest, our revaluations based on experience and based on revaluation from the actuary, and then our contribution that's being made. Requirement 2 is that we want to calculate our 28 earnings after pension expense is recorded, ignoring any income tax, and then also calculate comprehensive income, closing balance of retained earnings, accumulated OCI, and our statement of financial position net defined benefit liability. So let's first look at what's going to happen on the statement of comprehensive income. Okay. So on the statement of comprehensive income, we're going to have earnings, right? And these are going to be the earnings that are given to us. Okay, so we know they were $5,850,000, excluding pension expense. Okay, we haven't deducted that pension expense as of yet. Okay, and this would be a credit. Remember, revenue accounts increase on a credit. But we did just calculate our pension expense, right, through our journal entries. We increased pension expense by $85,375, as well as by $19,465, which gives us a total of $104,840. This is going to be a debit, right? Expense accounts increase on a debit. So our earnings then, the earnings provided minus our pension expense, giving us an amount of $5,745,160. Okay. In terms of OCI, our other comprehensive income, we have pension adjustments, right? Because we just made those through our journal entries. For OCI, we had $87,138, and we're going to add to that the $70,000. Okay, that gives us an amount of $157,138, and we know that these were credits to OCI. When we add those two amounts together, we're going to see our comprehensive income of $5,902,298, obviously being a credit. Okay. So after our statement of comprehensive income, we're going to look at the changes on the statement of our changes in equity, starting with our opening balance. Okay, and there's actually two components that we're looking at here, our retained earnings, and then also our accumulated OCI and pension. Okay, so our opening balance for retained earnings is given to us as $7,800,000. Okay. Let me move this over by one because I want to include a column that indicates whether it's a debit or a credit balance. Okay. Accumulated OCI had a balance of $100,900 on a debit. So opening balances are provided to us. Next, we want to look at those changes to comprehensive income, right? So the changes to retained earnings relate to our earnings, $5,745,160. And we know that was a credit. And the changes related to our OCI for pension adjustments were 157, 138 on the credit side, which means our closing balance, here we have two credits, so we get to add them together. Okay. Over here, we have a debit and a credit. Looking at this, our credit is the larger of the two, which means we will have a credit balance. In terms of the statement of financial position, okay, we're going to start by looking at our long-term liability. Then we will look at the retained earnings to see how everything plays out. Okay, so we have our net defined benefit liability. And this is something that we're going to calculate. So I'm just going to put in the other information that we need to include so that we have space to do our calculations. So we know on the statement of financial position, we're going to display any of our assets, liabilities, as well as any equity. So our equity accounts that we just calculated above being our retained earnings and our accumulated OCI related to our pension. These amounts we're just carrying from up above, so those ones can come down into place. Okay. And now we can look at calculating our net defined benefit liability. And we've done this a few times so far, but we'll go through it again. So we have our opening balance. Okay, and this is an amount that was given to us way back up here, right? The net defined benefit liability on our statement of financial position was $324,410. So that's what we're starting with. We then had our service costs, right? We had a credit for $85,375. We had our amounts related to our net interest, which was $19,465. Again, sorry, these are all credits. Okay. Next, we had a debit based on our experience, right? So that was our experience gain that I'm going to display as a negative amount since it is a debit. Okay. We then had our remeasurement gain, which again, I'm going to display as a negative amount since it is a debit. Okay, and then we have our contributions that were made. Once again, displaying as a negative amount because it is a debit. When we sum all of this together, we get an amount of $217,884 on the credit side, which is going to be what is displayed as the balance on our statement of financial position. Okay. The last part is that this asked for us to prove that the SFP liability account represents the net defined benefit position of the pension fund. Okay, so our proof. So let's start by looking at our obligation. Okay, we have that opening balance, and that's the amount that was given to us. So our obligation had an opening balance of 1,400,200. Okay, we want to add to that the amount for our service costs from over here. Then we want to look at our remeasurement, which we know was 70,000. Okay. Then we want to look at our net or at our interest. And here's where we have to break that down into kind of two components. Okay. We want to look at the interest expense that would be generated based on the obligation. So rather than netting it out and then multiplying by the yield rate, here we're going to take the full amount of our opening balance for the obligation and multiply by our yield rate of 0.06, which gives us an amount of 84,012. Okay. So when we do all that, we're going to get an amount of 1,499,587 that relates to the obligation. Okay. Then we're going to deduct from that the market value of our fund assets. And this is provided to us in the actuarial report. Okay. Our market value. Okay, so this is based on our beginning market value, contributions that are made, our actual portfolio performance, gives us an amount of 1,281,703. 1,281,703. And when we take our obligation and subtract that market value, we arrive at the same amount. Okay, so the position of our pension, we've proved, is consistent with what we are displaying as our net defined benefit liability on our statement of financial position. So pensions are one of those things that there's a lot of components that we need to take into account, and so it can be kind of overwhelming. So please make sure that you're doing the homework. I'm going to post the solutions for both the in-class assignment as well as for the homework, so that you're able to check your work. Quiz for Chapter 19 is open, or will be open today. Your take-home test number 2 is due tonight, so make sure you've gotten that completed, and then we will move on to Chapter 20 next week.